The Vanguard FTSE All-World High Dividend Yield ETF is the most popular dividend ETF on the market. With more than 2,000 dividend-paying companies from all over the world, including the emerging markets, this fund is massively diversified. With a single product, you invest in almost every major dividend company worldwide and never have to worry about anything. No surprise that many investors use this ETF as the core of their portfolio. But since the beginning of this year, a new ETF has entered the market, one that might actually challenge Vanguard's dominance. I'm talking about the L&G Global Quality Dividends ETF. This fund looks similar to the Vanguard ETF in many ways, but in a few key areas it takes a very different approach. In my opinion, the L&G ETF is also a strong candidate for a core investment, maybe even stronger than the Vanguard ETF. In this video, we break down both ETFs to reveal their similarities and the crucial differences that set them apart. But as always, this is not financial advice, just my own opinions and experiences. For this comparison, I'm using the website Extra ETF. Since the platform doesn't currently support English, I used my browser's built-in translation feature. So don't be surprised if a few words look a bit strange. On the left side, we have the Vanguard ETF, and on the right side, we have the L&G ETF. The Vanguard ETF has been on the market for 13 years and has grown into a giant with more than 7 billion euros in assets. The L&G ETF is only a few months old, but demand is huge, and it has already collected over 100 million euros, as we can see on the L&G website. Both ETFs invest globally and use physical replication. They are domiciled in Ireland, and both charge 0.29% per year, which is still reasonable for dividend ETFs. All of that together already makes this a very strong foundation for a core investment. What sets these two apart from other global dividend ETFs is their massive diversification. The Vanguard ETF holds over 2,000 companies, while the L&G version holds around 1,000. I don't know of any other dividend ETFs that hold this many stocks, not even close. This explains the huge surge in interest Vanguard has seen over the last few years. For a long time, Vanguard was the only player offering this level of variety, but now we have two. Since L&G has less than half the holdings, you might think it's poorly diversified, right? Even though it has fewer companies, they are all equally weighted within the fund. Vanguard, on the other hand, uses traditional market cap weighting, as you can see here on their website. Sure, that approach has its benefits, but it comes at the cost of true diversification. Take a look at this list of holdings I downloaded from Vanguard's site. While the top position, JP Morgan Chase, makes up 1.7%, the company at rank 100 drops to just 0.2%. By the time we hit position 500, the weight is a tiny 0.04%, and it only goes down from there. Now, let's look at a direct comparison of the top 10 holdings for both ETFs. These top 10 positions represent 11% of the Vanguard fund, but only 3% for L&G. Another interesting detail: Vanguard focuses on large and mid-cap companies. But L&G goes a step further by including small caps as well. That is a rare find, especially for a dividend ETF. Long story short, both are incredibly well diversified, but L&G actually takes the lead here, and I think that's a huge plus. If you're enjoying the video, a like and subscribe really helps the channel. Thanks. Now let's check the country allocation. Again, we see very strong similarities between both ETFs. I really like this mix. It isn't too heavily weighted toward the US, and it includes solid exposure to Japan, Canada, and Europe. It's exactly what you'd expect from a well-balanced global dividend ETF. Vanguard takes the lead here because it includes emerging markets like China and India. However, the actual exposure to emerging markets in this fund is quite small. It's under 10%. In an all-world fund, I'd prefer to see 20% or even 30%, but I suppose it's better than nothing. Now let's move on to the sector allocation. Once again, there are no major differences to report. We see typical dividend sectors here, like financials and industrials. Overall, both ETFs are positioned quite defensively. That's actually an advantage if you're looking for a solid dividend investment for the long term. All right, so far we've seen that both ETFs invest globally, are extremely well diversified, have the same costs, and are overall very similar. But now we get to a crucial point where the two ETFs really differ: the selection criteria for the companies that enter the fund. Since each ETF tracks an index, we can look into the fund documents to see how they choose their companies. The Vanguard ETF tracks the FTSE All-World High Dividend Yield Index. The selection criteria here are pretty simple. The index is comprised of large and mid-sized company stocks, excluding real estate trusts, in developed and emerging markets that pay dividends that are generally higher than average. In simple terms, they invest in pretty much anything that pays a dividend. There is no quality filter applied. With L and G, the approach is completely different. This ETF tracks the FTSE Developed All-Cap Dividend Growth with Quality Index. As the name suggests, quality is the key word here. Only companies with at least 10 years of consistent dividend growth make the cut, and those dividends must be sustainable. On top of that, they check for a positive return on equity, making sure the companies are actually profitable with the capital they use. There are also ESG filters applied. I'm just mentioning it. You can make of that what you will. So, to summarize, Vanguard more or less collects every dividend payer out there, while L and G focuses on financially healthy, profitable companies with growing dividends. I don't know about you, but personally, I much prefer the L and G approach. All right, let's take a look at how the total return performance of these two ETFs has developed in recent years. Since the L&G ETF is brand new, we only have head-to-head data starting from January. So far, both ETFs have performed almost exactly the same. Now, I know what you're thinking. A 3-month comparison is pretty much useless, and you're absolutely right. But here's what we can do instead. While the L&G ETF itself is only a few months old, the index it tracks has actually been around for 5 years. By digging into the official FTSE index documents, we can see how they compare over a much longer period. I've pulled those numbers for you right here. As you can see, the total return over the last 3 and 5 years is nearly identical. We also have to admit that both indices delivered very strong results over this period. Interestingly, both indices even outperformed their parent versions over 5 years, even though those parent indices are much more tech-heavy. Of course, nobody knows for sure how these two ETFs will perform in the future. But if I had to make a guess, I'd bet on the L&G ETF coming out slightly ahead in the long run. Quality companies usually have a habit of outperforming the broader market over time. Both ETFs work well as a set-and-forget core investment for a dividend portfolio. But hold on, we haven't even talked about dividends yet, the main reason people buy these ETFs in the first place. Let's start with the Vanguard ETF. It pays out 4 times a year, following the classic schedule: March, June, September, and December. Since its launch, the average dividend yield has hovered around 3.5%, which is actually quite respectable. However, the yield has dropped since 2022 and is expected to fall below 3% this year. Part of that is due to a weaker US dollar, but it's also a victim of its own success. The share price has surged since 2022. It's basic math. When the price goes up, the percentage yield naturally goes down. What I really appreciate, though, is how reliable Vanguard's payouts have been. Since the beginning, we've even seen a small but very steady growth trend. So, how does the L&G ETF compare? First, the good news. It pays out monthly, which is a dream for anyone who loves regular cash flow. The catch is that we don't have a real dividend history to look back on yet. So far, the fund has only made 2 payouts, as you can see right here. But if the upcoming payments look anything like the first 2, we're looking at a yield of over 4% this year. That would be incredibly impressive. Another hint that the yield might indeed be in that range can be found in the fund brochure on the L&G website. According to the document, the underlying index delivers a yield of 3.7%, which is actually higher than Vanguard's average yield. Let's be honest, though. We don't know whether the ETF can maintain such yields over a longer period, because that would be almost too good to be true. Right now, the L&G ETF is paying more than the Vanguard ETF, and we don't know if that will continue, but I think L&G can at least keep up. Another advantage of the L&G ETF when it comes to dividends is this. The index only selects companies that show dividend growth. That means we can expect some growth in payouts over time, which is extremely important to me. What I'm trying to say is this. Even if the L&G ETF ends up with a slightly lower yield than the Vanguard ETF, it could easily make up for that through dividend growth over the years. To wrap things up, both of these ETFs are excellent set-and-forget options for anyone looking to build a rock-solid dividend core. They share a lot of common ground, from their low costs and global reach to their incredibly defensive positioning. What really makes both funds stand out from the crowd is their massive diversification. You simply won't find many other dividend ETFs that hold this many stocks. Whether you choose Vanguard or L&G, you're getting a high-quality product that can serve as the foundation of your portfolio for years to come. In my opinion, both are great choices for a core investment, and in the long run, it's hard to go wrong with either one. However, if I had to pick a winner, the L&G Global Quality Dividends ETF feels like it has the upper hand. Its focus on financially healthy companies, the inclusion of small caps, and the monthly payout schedule give it a unique edge. When you combine those quality filters with the potential for higher dividend growth, L&G just seems like the more modern, optimized choice. Of course, Vanguard remains a reliable giant, but for me, the L&G approach is simply hard to beat. But hey, if you really can't decide between them, there's always the option to just put both into your portfolio and get the best of both worlds. All right, that's it for today. What do you think of these 2 ETFs? Which one do you already have in your portfolio? Let me know in the comments below. Don't forget to like and subscribe. Thanks for watching, and I'll see you next time.